Let's jump right in and unpack the financial health, leadership, and market position of ad tech giant Magnite. Today, we're putting their Q1 2026 filings, their latest proxy statement, and a recent credit upgrade from S&P Global right under the X-ray to see exactly what's driving their business under the hood. If you want a crystal clear picture of where the digital advertising space is actually heading, well, this is the explainer you need to watch.
To perform this corporate X-ray, here's our game plan. First, the Magnite business model. Second, those Q1 2026 financial results. Third, executive compensation and proxy. And finally, the market view and future outlook.
All right, kicking things off with Section 1, the Magnite business model.
So Magnite is essentially the ultimate independent middleman. You know how this works? They specifically serve publishers who want to sell their ad space to high-quality buyers. They're providing a programmatic platform complete with ad servers and audience data solutions. The whole point here is allowing publishers to effectively monetize their inventory, while handing advertisers the keys to premium, highly targeted ad placements.
Now, this whole operation really builds out into two distinct channels. You've got Magnite Streaming, that's their rapidly growing connected TV or CTV segment, and then there's Magnite DV+, which handles their more traditional display and video stuff across desktop, mobile, and audio. Management has made it super clear. While display and video is expected to be a stable grower, mostly bolstered by mobile apps and audio, CTV, that is the absolute high-growth engine of the company right now.
And guys, to put their scale into perspective, they process around 100 trillion ad requests every single month. 100 trillion. That massive infrastructure, combined with a laser focus on premium CTV partnerships with absolute giants like Disney, Roku, and Warner Bros. Discovery, it gives Magnite some serious pricing power. In fact, CTV now consistently drives over 40% of their contribution excluding traffic acquisition cost, or ex-TAC. That is heavily shifting the company's revenue balance straight toward a streaming future.
Okay. Moving right along to Section 2, Q1 2026 financial results.
And despite macroeconomic pressure in verticals like automotive, Magnite's core engine is just generating massive top-line volume. We are talking about a staggering $722.55 million in trailing 12-month revenue. That's a huge number. On top of that, they reported an adjusted EBITDA of $42.9 million for Q1 2026. That is a solid 16% year-over-year increase. And it's really worth noting here. Their EBT to margin increase, it's being entirely driven by cost efficiency at this point. We're talking things like major savings on cloud usage. Management actually expects EBT to margins to hit about 35.5% this year. The takeaway? Any upside in revenue is going to flow almost entirely straight to free cash flow.
CEO Michael Barrett's overarching strategy is actually pretty simple. He literally calls Magnite the easy button for CTV. By simplifying the buying process across what we all know is a highly fragmented streaming landscape, they're basically cementing themselves as the definitive gateway for advertisers who just want to reach those streaming audiences without the headache.
So fundamentally, the company is really healthy. The flip to positive profitability, net income of $4.41 million, and basic earnings per share of 3 cents for the quarter. But more importantly, they generated a very healthy $23.3 million in operating cash flow. It shows they're successfully managing that business mix shift towards CTV, all while continuing to build up their cash reserves.
Let's pivot to Section 3, executive compensation and proxy.
The upcoming proxy vote covers your pretty standard corporate governance items. Stockholders are voting to re-elect 3 highly experienced Class 3 directors, that's Paul Kane, Doug Nupper, and David Pearson, to serve until 2029. They're also ratifying Deloitte as their accounting firm and casting those standard advisory votes on executive compensation, plus the frequency of those comp votes going forward.
Now, when it comes to that compensation, the committee specifically designed the CEO's pay so that a massive 89% of it is tied directly to financial or share price performance, not a guaranteed base salary. This heavy emphasis on at-risk pay, it's obviously intended to align executive motivation directly with long-term stockholder value. A really large portion of this gets delivered via performance stock units, or PSUs, which vest based on how Magnite's total shareholder return actually compares to the Russell 2000 index.
Digging into the proxy data, you can see exactly how the compensation actually paid to the CEO. Those dark blue bars correlate super closely with total shareholder return, which is the pink line, and the broader S&P Internet Select Industry Index. It makes sense, right? When the stock dips, like it did back in 2022, the executives' realized value drops significantly. But when it appreciates, like we saw in 2024, their compensation goes up.
By contrast, though,
When we look at executive pay against net income, the relationship isn't nearly as tight. The Compensation Committee openly notes that executive pay is much more strongly correlated to stock price performance than strictly to net income. And that's a clear, intentional structural choice. They want to keep leadership completely focused on the actual value returned to the shareholders.
Finally, let's wrap up with Section 4, Market View and Future Outlook.
So, S&P Global recently upgraded Magnite's credit rating to BB, and they did this based on some incredibly strong liquidity metrics. Coming into 2026, Magnite was sitting on a huge $553 million cash balance. S&P actually expects the company's sources of liquidity to exceed their uses by about 5 times this year. Combine that with a covenant-light debt structure and super healthy free cash flow generation, and they are sitting in a highly defensible financial position.
But we have to be real. S&P did identify some clear risks. Magnite's older display and video segment relies on inventory that is just becoming increasingly commoditized, and that could really put pressure on pricing. Plus, as the whole digital advertising industry evolves, stricter user data privacy controls could absolutely temper the overall appeal and efficacy of programmatic advertising. It's a constant threat that could restrict advertisers' access to that targeting data they all crave.
Looking ahead, to sort of power through those risks, management sees 2 major tailwinds. In the near term, through 2026, they are expecting massive volume boosts from live programmatic sports streaming. They specifically highlight huge events like March Madness and the Summer World Cup. Then, leading into 2027, their current AI workflow integrations are expected to shift gears, moving from just saving costs to directly expanding margins and driving real revenue growth by increasing working media efficiency.
So the ultimate question we're left with is this. Can Magnite actually navigate a pretty sluggish macro environment and turn live sports and AI into sustainable, long-term profit? Look, they've got the scale, they've got the marquee partnerships, and they certainly have the cash to do it. But executing this full pivot to streaming, that's going to be their ultimate test. What do you think? Will they pull it off? Thanks for diving into the numbers with me today on this explainer.